This is Macro Horizons, episode 365, The Macro Ides of March, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of March 16th. And for anyone keeping track at home, Sunday is the Ides of March, and all that implies. A2 Brent, A2? Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, investors across all financial markets remained focused on the energy sector as the ramifications from the conflict in Iran and the Iranian response continued to drive both the news cycle as well as price action, particularly in U.S. rates. The theme was one of deleveraging and risk management flows, and by that, we simply mean a mini dash for cash as investors sold the front end of the curve and 2s, 10s flattened rather dramatically. We also did have a few data points of note, none of which really defined forward expectations on the macro front, but nonetheless warrant a nod. Specifically, core CPI for the month of February came in at 0.2 as anticipated. On an unrounded basis, that was 0.216 compared to January's 0.295 and represented the smallest core CPI gain since November. The supercore measure, core CPI services excluding rent and OER, increased just 0.35% in February compared to January's move of 0.593%. There does seem to be a notable amount of seasonality in supercore inflation in recent years, with a strong start in January moderating over the course of the first quarter. And all else being equal, we expect that that's how supercore inflation will behave this year. Core PCE for the month of January surprised slightly on the upside at 0.4% on a month-over-month basis. However, on an unrounded basis, the move was up 0.363%, so a low 0.4. Nonetheless, this continues to illustrate the divergence between core CPI and core PCE. It's worth acknowledging that last week's core CPI was for February and core PCE was for January. Nonetheless, within the details of core CPI for February, there does seem to be a bias developing for a stronger core PCE for the month of February as well. So, with this backdrop, it wasn't particularly surprising to see conversations surrounding the Fed funds outlook being focused on pushing rate cuts further into 2026. We're certainly not in the zero Fed cut rate camp, if for no other reason than all of the uncertainty related to the employment market that has emerged following the February payrolls print. We also saw a surprising downtick in the University of Michigan's 5 to 10 year inflation expectations component. That number came in at just 3.2%. Given the run-up in energy prices and the forward inflationary implications from the conflict in the Middle East, one would have expected, as was represented by the consensus, that consumers would be increasingly worried about higher prices at the pump. Nonetheless, given the data collection period of the University of Michigan survey, we expect that as revisions come in over the course of the month, that we will see upward pressure on that measure.
Well, it was quite the week in the Treasury market, and, frankly, not even because of anything having to do with the fundamental economic data. After all, CPI came in broadly in line with expectations. Treasury supply was something of a mixed bag in terms of auction demand, and frankly, the overall data, whether it's JOLTS, UMISH, Core PCE, were all close enough to expectations that the primary driver of the moves across markets remained the ongoing conflict in Iran and what's happening in the Strait of Hormuz. The most material reaction in rates, and what occupied the bulk of our client conversations this week, was the price action in the very front end of the curve, and in turn bear flattening of treasuries, as the market priced out a full rate cut in the US over the balance of 2026, and two-year yields made it to their highest level since August at 376. And so a great deal of the uncertainty has been derived from the price action itself, as investors are debating what a more sustained, elevated oil price environment will mean for the monetary policy backdrop. Undoubtedly, there was a positional component at play as well, but whether one is looking at the 50 basis point sell-off in the December SOFR contract or the 75 basis point sell-off in the SONIA December contract, the question this week was, what is going on in the front end?
And I suspect that that's a question that is going to persist in the week ahead. From a fundamental perspective, two-year yields above effective Fed funds implies that not only is the Fed not going to cut rates this year, or next year, but also that there's a non-zero probability that the Fed's next move might be a hike. Now, that's clearly not our base case scenario, if for no other reason than the type of inflation caused by higher energy prices tends to be the type that the FOMC is more apt to characterize as a tax on the consumer as opposed to true demand-driven inflation. Said differently, a larger expenditure on fuel costs means less discretionary spending elsewhere. Now, to be fair, we have yet to see such a major rotation occur within the personal spending series, but as the data for the first quarter continues to come in, that's certainly an area that warrants watching. Now, in terms of trading the conflict in the Middle East, it's very clear that investors are viewing what's occurring in Iran primarily from the lens of its inflationary implications. This implies that if oil takes another leg higher in the week ahead, that one should anticipate a further bear flattening of the yield curve. When contemplating when to reset curve steepeners or be more aggressive in buying the dip, we're left to ponder two potentially bond bullish scenarios. The first, which we'll characterize as the most likely over the course of the next several weeks at least, will be financial markets moving away from trading the conflict in the Middle East. That doesn't mean that we're anticipating any resolution, rather that as the market becomes habituated to the headlines associated with the military action in Iran and Iran's response, that the first leg will be stabilization in the energy sector, and in the event that we don't see another leg higher in oil and gas, then one should expect a gradual retracement off of the recent highs, which should remove some of the bond bearish sentiment in the Treasury market. On the flip side, in the event that we see $150 or $175 a barrel oil, then one should look to risk assets to see how well financial conditions can withstand such a supply shock from the energy sector. Needless to say that a swift move of that magnitude would most likely be accompanied by a far more severe correction in the equity market, thereby tightening financial conditions and putting in a supporting bid for treasuries. Again, not our base case scenario, but certainly something that needs to be on the radar as we think about the potential event risks coming out of the Middle East.
And there's another admittedly less quantifiable aspect of the markets and, frankly, the world's reaction to what's happening in the Persian Gulf to consider as well, and that is the political viability of continuing the war on both sides. From an Iranian perspective, and for an economy that is heavily reliant on the navigability of the Strait of Hormuz, it's probably in Tehran's worst interest to not allow oil to pass through the strait for a prolonged period of time, given the self-inflicted economic damage that could potentially impart on what's obviously going to be a very volatile time for the country going forward. Conversely, it also remains to be seen how willing the White House is to continue escalating the conflict, given what it's meant for oil prices, prices at the pump, and ultimately consumer sentiment and behavior, looking ahead to quickly approaching midterm elections. Now, the original timeline laid out by Secretary Hegseth and President Trump centered around 4 or 5 weeks for the strikes to continue, and we've nearly reached the halfway point of that timeline, and so it's not unreasonable to assume that at some point over the next week or so, we could start to see a shift in tone toward more focus in ensuring safe passage of oil tankers through the Strait of Hormuz, which purely from an economic point of view would help decrease the ramifications of the conflict.
It goes without saying that the geopolitical situation has overshadowed pretty much everything else in financial markets at the moment. However, it's worth taking a step back and noting that the private credit concerns have not gone away, and they do continue to simmer in the background. And while this clearly hasn't driven a durable, safe haven bid for treasuries, certainly not since the beginning of the war in Iran, it is an important background factor to keep in mind, and we could readily see it back in the driver's seat of the macro narrative in the event that there is a degree of stabilization in the Middle East. And again, by stabilization, we don't mean that the situation is quickly resolved, rather that the pace of escalation decreases, thereby affording investors the opportunity to look elsewhere for potential drivers of price action in U.S. rates as well as equities.
And there was another thing that was overshadowed by what's going on in the oil market, and that is what we saw in the February employment report. An 82,000 drop in headline NFP hardly paints as optimistic a picture on the labor market front to start the year as was originally presumed to be the case for much of the start of 2026. Now, it's certainly still too soon to say whether this is a full-fledged turn in the labor market cycle, and the next stop for the unemployment rate is going to be 5.5% or 6%. But what it does exemplify is that for all the discussion around the potential tightening of the labor market or even a chance of a reacceleration in the pace of hiring, February's data takes some of the edge off that argument and at a minimum preserves this low hiring, low firing dynamic equilibrium that we found ourselves in, if not potentially suggest a more troubling path forward for jobs. It will be interesting to see how Powell weights the February jobs numbers in his comments next week at the press conference. But the fact that we had a contractionary payrolls print even before this increase in oil prices and what that's going to mean for economic growth and potentially companies' abilities to hire new workers suggests that at a minimum, a rate hike is probably not going to be the next move from the FOMC. And if anything, it reinforces the easing bias that's certainly present under Powell and we expect will be even more pronounced once Warsh takes the helm in just a few months.
It's also worth highlighting that there are key parallels between how 2026 has begun and what we saw in 2025 and 2024. We came in to both of the last 2 years leaning relatively bond bullishly as a market, certainly skewed more dovishly toward the Fed, only to see that bias shift rather dramatically in the first quarter. Recall that in 2024, there was a surprise stickiness and higher than expected supercore inflation prints that served to delay the Fed's rate cuts until later in 2024. Similarly, we came into 2025, and with the introduction of the trade war and all of the uncertainties associated with the new administration, rate cuts were delayed until later in the year. The recent price action has been very much in keeping with that pattern as we watch rate cuts get pushed further and further into 2026, and frankly, the bulk of the move now appears to be a 2027 event.
And in fact, to look at the shape of the futures curve in 2027, with not even 20 basis points of policy easing priced in for next year after these latest moves, even if the Fed does need to rethink the timing of the easing cycle, it's going to continue, and that probably means more capacity for a greater inversion between 2026 and 2027 futures in the event that a broader rethink about the appropriate path of policy rates is not about to be delivered from the FOMC.
So what you're saying is one inversion after another.
Viva la revolución.
In the week ahead, we would like to assume that Treasury market investors will be focused on the FOMC decision on Wednesday and the accompanying press conference, as well as the updated SEP. However, the reality is that headlines coming out of the Middle East will continue to dominate the news cycle and set the broader tone for financial markets, as has been the case since the beginning of the war in Iran. Now, even as equity prices are decidedly off of their peaks, we maintain that risk assets overall have been holding in remarkably well, all things considered. This fact is made doubly so when we think about how far 2-year yields have backed up over the course of the last several weeks. Given that the Fed is in a rate-cutting cycle, we tend to view effective Fed funds as the upper bound or the ceiling for nominal 2-year yields. As a result, we're looking at the 2-year sector at the moment as comparatively cheap and would expect that the path of least resistance for 2s at least would be lower. Now that won't necessitate a steeper yield curve per se, particularly in the event that a move lower in rates is a function of safe haven flows related to a more material downshift in the performance of risk assets. Nonetheless, with this backdrop, we will be watching the FOMC rate decision. Expectations are appropriately for no change in the policy rate as monetary policymakers take more time to assess the macroeconomic ramifications from the war in the Middle East. Now, prior to the Fed's period of self-imposed pre-meeting radio silence, the tone of the Fed rhetoric emphasized a wait-and-see stance as it relates to the war in the Middle East, and the fact that it is difficult to estimate the ultimate impact of such events until we have greater clarity. The most important clarity will come in the form of how long oil and gas prices remain elevated, and in the event that they do drift back into the prior range, what the post-war bottom of that range ends up being. Clearly, this is not information that the FOMC is going to have this week, but nonetheless, the market will be focused on the 2026 estimate for core PCE. There is a bias for a revision higher, if for no other reason than the firmer January core PCE numbers, as well as a risk that the war in the Middle East drags on longer than the 5-week guidance already given by the administration, and therefore risks ultimately seeing a reasonable amount of pass-through from headline inflation into the core series. We maintain that it's too soon to have that as a base case, but the longer energy prices are elevated, the greater that risk becomes. Within the SEP, the market will also be looking at the 2026 dot and the amount of rate cuts being signaled. Our base case is that the Fed will maintain the 25 basis point rate cut assumption, but we could see an increase in the divergence of estimates for the year ahead. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we enter the last week of winter and the snow finally begins to melt, we're truly looking forward to once again seeing the ground and hopefully finding that lost glove. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.